an increase of a quarter point by the Fed was no surprise at all. So it was not a shock. I do want to remind people, I've been talking about this, I've been talking about it for many years, that eventually we would have a two-tier market. We would have a paper market and a physical market, and that is really coming to the forefront right now. You've got gold in Shanghai trading between $55 and $65 an ounce higher than on COMEX and LBMA. In silver, it's even bigger. It's over $2 an ounce now. So you're getting into the range of 12, 13, 14% physical premium in Shanghai versus our paper prices. At some point in time, you've got to ask yourself, which market is the real market? And I mean, that's pretty simple to answer, because China is the true demand for real metal. I think it was last week they took 52 tons or 58 tons for the week, and that brought them over to over 200 tons for the month. That's all the world produces in a month, is 200 tons of gold. So essentially, China bought every single ounce that was taken out of the ground for the month of November. They are the market. So watching the price get slaughtered with thousands of contracts and billions of dollars worth of paper or fake gold, it's not gold. Yes, it's disheartening. I know people are disheartened to see it, but look at the pricing in the physical market. That spread is getting bigger and bigger and bigger. I just wrote an article, I think it was Monday or Tuesday, talking, and I made a quip at the end about net jets becoming a good investment. And people were saying, what are you talking about? Well, there's going to be a point in time where arbitrage just explodes. And you have to have transportation to move metal from west to east. In silver, we're way beyond the point where arbitrage can be done. So on a daily basis, COMEX and LBMA are running the risk of someone stepping up and buying contracts and turning around and demanding delivery immediately because of the arbitrage. Because you're talking about 12, 13, 14% in silver. You make the buy, you turn around and sell it in Shanghai, and it's a 12, 13, 14% locked in profit right there. And this is what we've talked about all along, is that we would go to a two-tier market. I did an interview last weekend for our subscribers, and Jim made the comment, you could see $10 an ounce for gold offered on the COMEX, no bid, and $5,000 an ounce bid in China and nothing offered.
Well,
that's where it could go.
Yeah, and I know that sounds crazy, but I mean, right now it's crazy to see a $2 arbitrage already in silver. I mean, this market is so corrupt, and because of the UBS, Deutsche Bank emails back and forth by those traders laughing as they were fleecing the sheep. And that's not even fair to call them sheep. It's a corrupt market, so anybody participating in it is going to be fleeced. And now we know it. It's in black and white. And do you think anything's going to change? Do you think any of those criminals will go to prison? No, of course not. Just like Podesta and Hillary Clinton are unlikely to go to prison.
It depends on what happens to the rule of law. They very well may go to prison.
Well, let me ask you this, Enrique.
Sean,
well, I hope they go to prison. They ought to go to prison. So, but we're going to need rule of law for that to happen, and right now we don't have it.
Well, we haven't had it for at least 7, 8 years, and then some.
Yeah, maybe since 1913.
Yeah, it didn't start in 8 years ago. It did start before that. But the hope is that we do move back to the rule of law. Before we go any further, I do want to mention we put up a note yesterday on the site because we get so many emails, so many just panicked people regarding what's going on with the dollar, what's going on with silver and gold and the stock markets. You have to understand that only one of two things can happen. Either they can get the system reflated, or they don't. And the scary part is if they don't, and it looks like they're not going to get a reflation. We're going to go through a massive deflationary event where everything collapses. What you have is you've got interest rates rising on top of the most leveraged credit markets in the history of history. And if you go back and if you look, every crisis that we've ever had has been when interest rates start rising, it pops something and something breaks. Now at this point, interest rates all over the world are rising. The only sector that's not rising is short-term in Germany. I saw this morning that the 2-year Bund is minus 0.78%, which is a new low for interest rates. And that shows you something's broken. It shows you that there's not enough collateral left for them to buy. But getting back to the reflation aspect, understand that gold in a deflationary environment does better than any other environment. Better than stable times, better than inflation or hyperinflation. In a deflationary environment, gold does better than any other possible scenario. And the reason being, what do you want in a deflation? You want money and you want liquidity. And that's what gold is. Gold is money and it's always liquid. So it's the ultimate asset to own in a deflation. There was a big firestorm last week and early this week. Martin Armstrong's out again saying that we're going to go under $1,000 an ounce. If you look at what he said in the past, he actually wrote an article, and I wrote about it. He wrote an article last year saying that gold was devalued in 1934. It was not devalued. It was revalued 70% higher. Went from $20.67 to $35 an ounce. And that was the Fed, that was the U.S. Treasury trying to fight deflation by inflating gold, by devaluing the dollar versus gold. So I would tell people, you've got a couple things here. You've got the cash markets telling you that the paper markets are more and more wrong every day because the spread is widening. And you also have history knowing that we're more leveraged than we've ever been before. And in the past, when interest rates go up, something breaks. And at this point, when something breaks, you're looking at a deflationary environment, and history shows you that gold is the safe haven, gold is the place to be in a deflationary environment. Gold is your insurance policy. Gold is going to be left standing when everything else is smoldering.
Well, they're burning the house down right now, and I want to share a little inside baseball with everybody. As we're having this conversation on Friday, the dollar index sits at 103.35, up $1.11. Bill, it wasn't very long ago that the dollar index was around 93, 94, 95. It has been on an absolute tear. Now, at the same time, gold and silver have been beaten down. And not too long ago, I had a conversation with a gold mining executive, and he was extremely concerned about the price of gold and the ability to stay profitable when gold was at $11.65. Mm-hmm. It's now at $11.25.
Right.
They are going to put gold producers out of business if they continue with this beatdown in the paper markets, because these guys cannot produce the stuff as cheaply as it's now selling.
Right. It's at very close to the cost of production on gold. It's probably slightly below the cost of production on silver. I think what you're saying is, I mean, we've had this rally uh, in stocks. You saw a rally similar to this after Reagan won. What I think you're saying, because we are in terminal stages, in my mind, there's no doubt. People are being lured, corralled, enticed, whatever you want to call it, to move into stocks with interest rates rising. And they're being shown on a daily basis that gold and silver are a bad place to put your money. It's a scary place and you need to get out. And it's my opinion that if they cannot steal the election and Trump does get to inauguration, gets inaugurated, I think they're just going to pull the plug. I think they're going to pull the plug. And what have they done? They've corralled people into stocks, and they've scared people out of insurance. So it's dastardly, but I think that's what they're doing, and I do think that they're going to pull the plug.
All right. Well, the other thing that's happening is these poor folks are finally waking up to the fact that they cannot count on their paper statements. You're down in Texas. Tell us about the Dallas pension plan we're hearing so much about. You've got cops in a panic because they're starting to realize they're not going to get their retirement money. The same thing happening in Fort Worth with an employee's pension plan in deep trouble. We know what's going on in the state of Illinois. It couldn't be more overextended as it relates to this stuff. California with CalPERS. People are going to end up with nothing. And they're waking up.
Well, think about it, Sean. If you were a police officer that worked for 20 or 30 years or whatever, and you find out that your pension plan is underfunded, and if you leave your money there, you're going to end up getting a cut. You're not going to get the benefits that they've been promising you. What are you going to do? You're going to pull the money. Well, as you pull the money, now the plan becomes more underfunded because you're taking out 100 cents on your dollar, which if the rest of the plan is 40 or 50%.
Right. It's a Ponzi scheme. You're taking out your money that they were going to pay other people with.
Right.
People are figuring this out.
If you're the last one out, you're not going to get anything.
Get nothing. Yeah, you're going to be a Madoff creditor.
I mean, that's just human nature. That's common sense. It's logic.
But that's what this whole system now is. It's one big Madoff Ponzi scheme. The Social Security thing, same thing. If people could get their Social Security money out, there'd be a rate on that right now too.
Well, Sean, you just said, that's what this is. It's a Ponzi scheme now. This has been a Ponzi scheme for years and years and years. And the reason we're coming to a head now is because we hit debt saturation. And how does a Ponzi scheme work? A Ponzi scheme works by taking in new money to pay past promises. And new money into our credit-based system relies on new debt. And at this point, even the sovereigns have saturated themselves with too much debt. There's no engine that can take on more debt or enough debt to continue to expand the Ponzi scheme. When new money stops coming in, the Ponzi's end. And that's what's happening. This is a credit collapse is what we're headed toward.
All right, well, let's finish the conversation by circling back to Martin Armstrong, because I don't think Martin Armstrong's a terrible guy. I think Martin Armstrong went to jail, just like Peter Schiff's dad did, for probably unjust reasons, and they weren't going to let him out unless he played ball. Maybe Martin Armstrong is playing ball. Maybe Martin Armstrong was told, you're going to talk gold down or you're never getting out of here, because it makes no sense, given all that we know, that gold would ever go back $1,000, and Martin Armstrong is not a stupid person. So what's going on here? Because it appears to me they are going to take gold below $1,000 an ounce if they can.
Well, that's the operative phrase there is if they can. I'm going to send you a couple of links that was sent to me yesterday. An article from 2010 regarding the silver market and 2011 regarding the silver market, and 2010 where he went through the math of the amount of gold that the U.S. has versus money supply, etc. In 2010, he was saying that gold's going to go at least to $5,000 an ounce, and that's a very conservative number. He did the math and came up with, I think, $53,000 an ounce is where gold was fairly would be valued if the gold we supposedly have backed the money supply. And then the second article, the one about silver, was about the drive-by shootings of manipulation in the silver market, and he went on a long diatribe about manipulation. Now, at this point, he denies that manipulation can create a market. That's not what he was saying back then, and he's saying that you should not own gold at this point because it's going to go under $1,000. Well, we're only $125 away from $1,000.
Right.
If back in 2010 he thought it was going to go to $5,000 as a very conservative number and did math saying it should be valued at $53,000, I don't understand the risk reward there. I mean, let's say that he's right and it does go to $900. By the way, if it does go to $900, I can pretty much assure you it will not be trading under $1,000 in China.
Right.
The spread will just get bigger and bigger. And as they've pushed these prices down, as I mentioned before, China just had a huge month of over 200 tons of gold that they took off the market. As they push the price lower and lower, they're creating more and more demand. It's like they've got a gun in both hands and they're shooting their own feet off as fast as they can. By pushing price down, they're increasing the demand.